The market isn't the scary thing. Your stomach is. If that line bothers you, good. It should, because successful investing is mostly temperament with a light dusting of arithmetic. Anyone can do this. You don't need a PhD. You need patience, curiosity, and the ability to sit on your hands when everyone else is flapping theirs. I ran the Magellan Fund for 13 years. 9 separate times the market fell more than 10%. All 9 times Magellan fell more than 10% too. Consistency, right? Here's the real point. The drops aren't bugs in the system. They're the admission price for superior long-term return. If you think stocks are a quick, safe way to double your money, try this trick instead. Fold the bill in half and put it back in your wallet. Perfect record. No drawdowns. Stocks are a long game. 5, 10, 20, 30 years. If you need the money for a wedding next summer or tuition in 18 months, stop. Buy a CD. Buy a pillow. Anything that won't be down 25% the one day you actually need it. Start with one question. When will I need this money? If the answer is soon, skip stocks. If the answer is, I can forget about it for a decade, welcome aboard. Volatility is not a malfunction. It's a feature. A normal stock can trade 50% between its high and low in a perfectly ordinary year. That's not the end of the world. That's Tuesday. What rescues you from volatility is time and story. Time lets compounding do the heavy lifting. Story keeps you in the seat while it's happening. Compounding is 5th grade math with adult-sized consequences. A small difference in return turns molehills into mountains. That's why stocks over long spans tend to beat bonds and bills. They're volatile, yes. They also come with the engine you need if you want your snowball to become an avalanche. But you don't earn the long-term equity premium by reading about it. You earn it by sitting through the parts you don't like. October drops, ugly headlines. Your neighbor's confident prophecy of doom delivered over the fence while he waters the lawn. So train the right organ, not your brain, your stomach. Here's a simple exercise before you buy any stock or stock fund. Write on a card, if this falls 20% in a month, I will. If you can't fill in that blank with anything calmer than sell everything and hide, you're not ready. Keep saving cash. Come back when your stomach grows up. Now, the good news, as an individual, you have edges Wall Street can't buy. You live somewhere. You shop somewhere. You work in a real job where real tools and real software either make sense or don't. That's a research lab. You can spot winners in your neighborhood long before they're blessed on a TV show with a ticker crawling underneath. But that's part 4. First, we need to make peace with market weather. Expect a 10% correction about as often as holidays. Expect a 25% drawdown often enough to get your attention. In 13 years, I had plenty of chances to panic. I had the same opportunities you'll have. Sell low, feel smart for a week, regret it for a decade. Here's the better plan. Rule 1, match your horizon to your vehicle. Short horizon, safe vehicle. Long horizon, accept volatility for higher expected return. Nothing complicated. Rule 2, decide the maximum pain you can absorb while still thinking clearly. That number isn't on a spreadsheet. It's in your gut. If a 15% dip ruins dinner, buy less stock. If a 30% dip ruins sleep, buy a lot less stock. Rule 3, own what you can explain in 2 paragraphs to a 5th grader. If the story depends on Greek letters, weather patterns on Jupiter, or the Fed's mood on Thursdays, pass. Simple stories live longer. Rule 4, ignore the background noise. Elections, interest rate predictions, celebrity CEOs tweeting about the moon, great entertainment, poor guidance. Behind every stock is a company. If earnings grow for years, the stock eventually follows. If earnings wither, the stock eventually follows that too. The market is a mirror, not a crystal ball. Let me tell you how this looks in real life. In 1987, the market fell off a cliff. If you kept your nerve, the next 5 years still beat bonds and bills. In 1990, the headlines were war, recession, and bank trouble. Plenty of strong companies with nothing to do with any of those things went on sale. The stories didn't change, only the prices did. That's the key distinction. Price versus story. Price can change in an afternoon. Story rarely does. Give your good stories time to work 2, 3, 5 years. Some of my best winners blossomed in years 5, 6, 7. That's not magic. That's business. Want a practical routine? Here's a starter kit. Label your money. Near-term needs and long-term compounding. Don't let those buckets mingle. Write your rules. I will not look at prices during a downturn more than once a week. I will add to great stories when the market sells them to me at a discount. Track stories, not prices. Every quarter, ask, are sales growing? Are costs behaving? Is the balance sheet healthy? Is the moat wider or narrower? If the answers are still good, volatility is a coupon. Keep a boredom list. Dull, understandable companies with persistent earnings can fund your patience while you hunt for the exciting ones. Practice not doing. The more you trade, the more you feed the fee machine and the tax collector. Activity is not a strategy. It's a habit. We'll get to scouting ideas from your daily life, sorting stocks into the right categories, and pricing them without a migraine. But none of that matters if your stomach quits first. So start there. Write the card. Set the rules. Choose a horizon you can live with. The market will test you. Good stories will reward you. And your stomach-trained, calm, patient will be your most valuable asset. You don't need to be a genius to get rich. You just need time and the patience not to mess it up. Compounding is the most boring miracle in finance. It doesn't shout. It doesn't sparkle. It just works quietly in the background while everyone else is trying to look clever. Then one day, you wake up and the boring little thing is turned into a mountain of money. For the past 60 years, stocks have averaged around 10% a year, bonds about 6%. Treasury bills and bank CDs, roughly 3%. Not much difference, right? Just a few percentage points. But those few points are the whole game, because compounding doesn't add, it multiplies. At 6%, your money doubles in 12 years. At 10%, it doubles in 7. That may sound like a math problem, but it's really a life problem. Waiting too long or settling for too little return means you work harder later. Take a simple case. You invest $50 a month and earn 6%. After 30 years, you have about $50,000. Not bad. But if you earn 10% instead, you'll end up with over $113,000. Same $50, same 30 years. Just a different vehicle. That's the quiet magic of compounding ordinary savings made extraordinary by time. Now suppose a 20-year-old invests $200 a month at 10%. By age 60, they'll have roughly $1.1 million. Start at 35 instead, and you'll need to put in $800 a month to reach the same number. That's the price of waiting 15 years. Compounding rewards the early bird and punishes the procrastinator. Time is the fertilizer of wealth. The longer it stays in the soil, the bigger the tree grows. But there's a silent thief: taxes. Every time you earn interest or dividends in a taxable account, the government takes a bite. It's not evil, it's arithmetic. But if you can delay that bite, compounding works faster. That's why if you don't need the money until retirement, you should use tax-deferred accounts, IRAs, 401 KECs, 403Bs, whatever you've got. Inside those accounts, your money compounds untouched. You don't pay taxes until you withdraw decades later when the snowball is enormous. That's not a loophole, it's common sense. Over time, stocks beat bonds and cash because they own something that grows. Businesses. A bondholder gets a promise. A depositor gets interest. A shareholder gets ownership of a growing enterprise. When companies reinvest profits into new stores, better products, and more customers, you get to come along for the ride. But ownership comes with mood swings. Stocks go up and down, sometimes violently. That's the toll you pay for long-term returns. Volatility isn't a problem, it's the price of admission. Compounding has two levers: time and rate. That's it. You can't control the market, but you can control when you start and how consistently you add. Draw two curves, one for the person who starts early, one for the person who waits. The early curve shoots up like a rocket. The late curve crawls. Once time is lost, it never catches up. Most investors underestimate compounding and overestimate their skill. They chase quick wins, forgetting the slow miracle. But compounding is like growing trees. You can't plant them today and eat shade tomorrow. You water, you wait, and one day you sit beneath something sturdy. The market rewards endurance, not brilliance. The biggest fortunes often belong to people who bought, held, and let arithmetic do its work. Every time you panic sell or take profits too early, you interrupt compounding's rhythm. You reset the clock. The goal isn't to find perfect timing, it's to avoid perfect excuses. You'll never guess the best day to buy or sell. Even professionals don't. Timing the market is like trying to jump on a moving train blindfolded. You'll probably get hurt. Staying in the market beats timing the market. Always has. Time in the market builds wealth. Timing the market builds stories about how unlucky you were. Since 1926, there hasn't been a single 20-year period in U.S. stocks where investors lost money. Not one. The market crashes, it recovers, it climbs again. Patience wins. Impatience just pays someone else's fees. Here's a simple playbook. Start early. Your first dollar is your best employee. It works longer than all the others. Stay consistent. Whether it's every month or every quarter, compounding loves routine. Let it ride. Don't dig up the roots every spring to see if they're growing. Reinvest dividends. Trust the math. Use tax-sheltered accounts whenever possible. Give your snowball the smoothest hill to roll down. Ignore predictions. Someone's always yelling about recessions, interest rates, or elections. They've been yelling for 100 years. The market keeps compounding anyway. Add when it hurts. The best time to buy stocks is when everyone else is looking for the exit. When headlines scream crash, prices are going on sale. Compounding doesn't require courage every day, just on the hard days. It's not about being fearless. It's about being consistent. Think about it this way. You don't need to make a fortune overnight. You just need to let time do the heavy lifting. The math never sleeps. It doesn't care about your feelings, the headlines, or your neighbor's opinion. It only needs two things from you: money and patience. People talk about investor intelligence, but what really matters is investor behavior. The math is simple, the emotions aren't. The ones who stay invested, keep adding, and ignore the noise end up rich. The ones who flinch at every dip end up broke, or worse, bitter. You can't hurry compounding. It's like cooking stew. You can't crank the heat to finish faster. You'll just burn it. The trick is to keep the fire steady and give it time. So before you chase the next hot tip, do something radical. Start early, save regularly, let it sit. It's not exciting, it's not dramatic, but it's the only guaranteed way to make time your business partner instead of your enemy. That's 5th grade math, no MBA required. Just patience, routine, and a strong stomach. Stay the course long enough, and the slow miracle of compounding will look like genius. Everyone wants the reward. No one wants the roller coaster. But here's the truth. Volatility is the roller coaster, and it's the only ride that takes you to wealth. If you can't stomach watching your stocks fall 10%, 20%, even 30%, you'll never enjoy the compounding that follows. Markets go down. It's not a bug. It's a feature. You don't get the long-term returns of stocks without enduring the short-term chaos of stocks. In the 13 years I ran the Magellan Fund, the market dropped 10% or more 9 separate times. 9. And every single time, my fund dropped too. I didn't have a magic parachute. I had a plan and a strong stomach. That's the difference between investing and reacting. Investors have horizons, reactors have headlines. If you invest with a 1 or 2 year time horizon, you're not investing. You're speculating. You're trying to time something that can't be timed. The market can fall 20% next week and rise 30% next year. And no one, not even me, can predict when either will happen. But over 10, 15, or 20 years, history says you'll be rewarded for staying put. Let's go back to 1987. The Standard & Poor's 500 fell 33% between August and October. It felt like the world was ending. The headlines were screaming Black Monday. And yet, if you'd simply held your stocks through that storm, by 1992, you'd have outperformed Treasury bills and long-term government bonds, even counting the crash. That's not optimism. That's arithmetic. The market doesn't move in straight lines. It zigs, zags, panics, and rallies sometimes in the same week. That's why patience is the most undervalued asset on Wall Street. Now, if you need the money soon for college tuition, a down payment, or your kids' braces, don't put it in stocks. That's not investing. That's gambling with your short-term needs. Stocks are long-term tools. If you can't leave the money alone for 5 years or more, you have no business being in equities. Here's how I like to frame it. Imagine you're planting an orchard. You don't plant apple trees and dig them up every season because it rained too much or too little. You leave them in the ground and let the seasons do their work. Stocks are the same. You let them grow through the ugly years because the harvest takes time. Volatility is the weather. Ignore it. Focus on the orchard. But let's be practical. It's one thing to say, stay calm, and another to do it when your screen is bleeding red. So how do you actually manage your emotions when the market starts falling apart? Start by writing this sentence somewhere visible. If the market drops 20%, I will do nothing. That sounds easy when prices are up. It's a lot harder when your portfolio is down and everyone on TV is panicking. But remind yourself the market has fallen 10% roughly every 2 years and 25% about every 6 years. That's as normal as winter. It's not a surprise, it's a cycle. Every bear market in history has eventually become a bull market. Every panic has been followed by recovery. The trick isn't predicting the turn, it's surviving it. People ask, Peter, when should I sell? My answer is simple. Never because of fear. You sell when your story changes, when the reason you bought the stock is no longer true. Not because the market had a bad week. Not because someone on CNBC raised their eyebrows. Behind every stock is a company. If that company is still growing, still profitable, still executing, the price will follow in time. If the company fails, no headline will save it. That's why you research the story before you buy. The story, not the stock price, keeps you steady. Here's another way to think about volatility. It's a sale. When good companies drop 20, 30, 40% for reasons unrelated to their business, that's a coupon. If you liked the company before, you should love it now. In 1990, when Saddam Hussein invaded Kuwait, the market tanked more than 20%. Banks were shaky, recession fears everywhere, but plenty of great companies had nothing to do with Iraq, oil, or banking, and their stocks still fell. That's when I bought. The stories were fine, the prices weren't. If you want a metaphor, think of the stock market as your favorite store. Once a year, it throws a clearance sale. Most shoppers rush in. Investors, they panic and run out the door. Don't be that shopper. Here's a useful exercise. Look at your portfolio and ask, which of these companies will still be around and making more money 10 years from now? If the answer is most of them, then stop checking prices. Let the math work. Market drops are opportunities dressed in ugly headlines. They test your temperament, not your intelligence. When you invest long enough, you start to see a pattern. Every time the world seems to end, recessions, wars, elections, interest rate scares, the same thing happens. Businesses adapt. People keep buying coffee, cars, and diapers, and the market eventually climbs higher. It's been doing that for over 100 years. The next time the market drops, remind yourself, this has happened before. It'll happen again, and the people who stay invested will once again look like geniuses. Volatility is not your enemy. Impatience is. You don't have to like market declines, no one does. But you do have to accept them, because they're the admission price for the best returns on earth. If you want absolute safety, go buy a savings bond and watch inflation quietly, eat your lunch. If you want growth, learn to stomach the ride. Investing isn't about predicting the weather. It's about building a portfolio sturdy enough to stand through every storm. And once you understand that volatility isn't a problem to avoid, but a toll to pay, you'll stop worrying about every bump on the road. You'll stop checking prices every morning. You'll sleep better. And ironically, that's when you'll start making real money. Don't waste your life trying to avoid volatility. Embrace it. It's the reason ordinary people become extraordinary investors. If you can survive the roller coaster without jumping off, you'll find the view from the top was worth every drop. You already have an edge. You just don't know it yet. People think successful investing requires a fancy office, a team of analysts, and computer screens blinking like Christmas lights. That's nonsense. Your edge isn't a Bloomberg terminal. It's your life. It's where you work, where you shop, and what you notice before anyone else does. That's the great secret of individual investors. You live closer to the truth than Wall Street ever will. When I ran the Magellan Fund, people assumed I had access to special information. In reality, my best ideas came from the same place yours will, the real world. A parking lot, a shopping mall, a conversation at a Little League game. I call it investing from the front row of life. You see products succeed before analysts see earnings reports. You notice full restaurants before anyone writes a research note. You experience the economy through your wallet, not a spreadsheet. That's your advantage, and it's completely free. Let me tell you a few stories. Once, my family bought a Volvo station wagon. It was safer than the American models, better built, and the price was right. Naturally, I got curious. So, I looked into the company Volvo, a Swedish automaker, and discovered the stock was selling for about the same value as its cash. Think about that. You were basically getting the company for free. The car wasn't just reliable transportation. It was a lead to a great investment. That's what I mean by using your edge. Here's another one. Back in the 1950s, a firefighter in New England noticed a local factory was always busy hiring people, expanding buildings, trucks coming and going. He wasn't an analyst. He didn't have a computer. He just paid attention. That company made Tampax. He invested $2,000 a year for a while. By 1972, he was a millionaire. He didn't time the market. He didn't chase hot stocks. He simply noticed something growing in his own backyard. That's an edge Wall Street will never have. Wall Street sits in offices analyzing numbers from companies they've never visited. You stand in the grocery store holding the product in your hand. Guess who's got the better seat? But here's the catch. Most people don't use their edge. They take what they see every day and completely ignore it. I'm guilty too. In the early 1970s, my own industry, mutual funds, was just starting to grow. By the 1980s, money was flooding into funds like mine, as well as Dreyfus, Franklin Resources, T. Rowe Price. If I'd bought those stocks, I could have made a fortune. But I didn't. It was staring me in the face, and I missed it. So don't assume you'll always recognize your edge. You have to train your brain to notice. The first step is curiosity. When you see a business thriving, full parking lots, long lines, repeat customers don't just think, that's nice. Ask, who owns this company? If it's publicly traded, congratulations. You just found a potential investment idea. That's how I found many of my 10 beggars. I didn't sit in an ivory tower. I went to the mall. I ate the food. I watched what people were actually buying. When you see a product you love, do a little homework. Look up the company's earnings, its balance sheet, its competitors. See if it's small enough to keep growing and strong enough to survive the tough years. If the numbers make sense and the story is solid, that's your lead. You're not trying to find 100 stocks. You only need a few. Most amateurs can follow maybe 5 to 8 companies, companies they understand well enough to give a short lecture on. That's more than enough. There are over 10,000 publicly traded companies in the United States alone. You don't have to know all of them. You just have to know your few better than anyone else. The best part? This isn't a full-time job. I used to own Dunkin' Donuts for 12 years. I talked to management maybe once a year. The story was simple and steady. People liked coffee and donuts, and the business kept expanding. That's it. You don't need to outsmart the market every day. You just need to recognize a good story when you see one and give it time. When you use your everyday life as a source of ideas, investing becomes less like gambling and more like observation. The truth is, most of the world's great investments didn't come from inside information. They came from noticing something obvious before it became obvious to everyone. If you're a mechanic, you already know which tools break less often. If you're a doctor, you see which medical devices save hospitals time and money. If you're a teacher, you know which software every school is adopting. Those are clues. That's your edge. Now imagine combining all those personal insights with a little bit of research. That's how ordinary people beat professionals who rely only on reports and ratios. Investing isn't supposed to be mysterious. It's supposed to make sense. If you can explain in plain English why a company's earnings are likely to rise and why the story will last a few years, you're already ahead of most of Wall Street. It's not about finding secrets. It's about paying attention. The next time you see a product everyone is raving about, a restaurant with lines around the block, a new gadget everyone's buying, a brand that seems unstoppable, ask yourself, who makes it? Who owns it? Is it publicly traded? That's where great investments begin. Not in conference calls, not in economic forecasts, but in daily life where the future quietly introduces itself. Your greatest advantage isn't money or data or access. It's observation and the patience to act on it after you've done the homework. So look around. Your next great stock idea might already be sitting in your driveway, in your kitchen, or on your desk. That's not wishful thinking. That's how real investors win. Investing is not about equations or forecasts. It's about stories, simple, believable stories. People who truly love stocks don't talk about charts or astrology. They talk about companies, products, and customers. They tell stories. But let's be clear, a story is not a fantasy. It's not, this stock will go to the moon. It's, this company will grow earnings because more people are buying what it sells, costs are under control, and management knows what it's doing. That's it. No fairy dust required. When I pick a stock, I start with a story I can explain to a 5th grader. If I can't explain it that simply, I don't buy it. Because the more complicated the story, the more likely it is to fall apart. Here's what a real investing story sounds like. When I bought Chrysler, I didn't say, I think the macroeconomic cycle is turning upward and global liquidity will expand. I said, they make minivans. People love minivans. The competition doesn't have one yet. The company's fixing its balance sheet and rolling out a 6-cylinder engine everyone's been waiting for. That's a story. It has characters, conflict, and a clear path to higher earnings. Research starts with curiosity, not calculus. You don't have to spend 10 hours reading financial statements before you form a view. Start by asking questions. Why do people buy this product? Is the company making more money each year? What could make profits go up or down? When I owned Chrysler, I used to ask random people at ball games or in parking lots, what do you think of your minivan? They told me it was a little underpowered. I knew management was already working on a 6-cylinder model. That confirmed my thesis. That's research. It doesn't require a PhD, just a conversation. The best investors aren't data junkies. They're detectives. They collect small pieces of real-world evidence that either strengthen or weaken their story. If you're a nurse, talk to doctors about which medical devices are saving time. If you're a contractor, notice which material suppliers are always backlogged. If you're a parent, pay attention to the brands your kids suddenly can't live without. Those clues are gold. You don't need to own 50 stocks. You only need 5 to 8 that you understand cold. When I say understand, I don't mean memorizing the price-to-earnings ratio or the dividend yield. I mean, you could stand up in a room and explain how this company makes money, who its competitors are, and what might make its profits grow over the next few years. If you can do that, you already know more than most professionals. Now, here's where most people go wrong. They confuse checking process with checking progress. Looking at the stock price 10 times a day doesn't tell you anything. It's like checking your weight every hour. It just makes you nervous. Instead, check the story. Has anything changed about the business itself? Are earnings still rising? Are costs under control? Is management still competent? If yes, then ignore the noise. The story's intact. The price will eventually catch up. I once owned Dunkin' Donuts for 12 years. 12! I talked to management maybe once a year. The story didn't change. People liked donuts and coffee, and Dunkin' kept opening more stores. No drama, no crisis, no sleepless nights. A simple story that stayed true was worth more than 1,000 clever theories. Sometimes stories change slowly, almost invisibly. That's why patience matters. Good stories take time to be recognized. A great stock can take 2, 3, even 5 years before it really pays off. Some of my best winners didn't shine until year 6 or 7. If you're expecting your stock to explode in a few weeks, you're not an investor, you're a tourist. And the market doesn't reward tourists. So how do you know if your story is good? First, it should be grounded in facts, rising earnings, expanding margins, solid balance sheets. Second, it should have a clear why. Why are profits likely to grow? Why will customers keep coming back? Why can't competitors easily steal market share? If you can answer those, you've got something. And remember, you can't have a good story without numbers. Even a simple one needs a few facts behind it. You don't need spreadsheets. You need common sense. Example, this company is growing earnings 10% a year. It sells at 10 times earnings. It's expanding into new markets. Debt is low. Management owns shares. That's a solid story. Or this, the company hasn't grown in 5 years. Debt is piling up and insiders are selling. That's a bad story. It's not complicated. It's just honesty. Here's a trick I use. Try telling your stock story out loud in under 2 minutes. If you can't, you don't understand it well enough. The company makes a product everyone's using. Sales are up 20% a year, they're opening more stores, margins are improving, and they have no debt. That's a story. This company uses a proprietary AI-driven algorithm to revolutionize synergistic data ecosystems. That's garbage. Investing isn't about how smart you sound, it's about how right you are. Don't mistake noise for knowledge. Focus on the story, the real business story. And when your story changes, when earnings stall, management drifts, or new competition appears, have the discipline to say goodbye. You're not marrying the company. You're dating it until the story stops being attractive. That's why you should write down your story the day you buy. Literally write it out in 2 paragraphs. Here's why I'm buying. Here's what will make me sell. Then check back every few months. Don't let the market bully you into changing your mind without evidence. The difference between a good investor and a lucky one is that the good investor knows why he's holding a stock. So don't memorize formulas. Tell stories short, simple, factual stories about real businesses solving real problems. That's what separates a gambler from an investor. A gambler bets on price. An investor bets on progress. And progress, slow, steady, boring progress is where wealth hides. Selling a stock is harder than buying it. When you buy, you're full of hope. When you sell, you're full of doubt. Everyone wants a rule. Sell when it doubles. Sell when it drops 10%. Those sound neat and they're completely useless. There's only one intelligent reason to sell. Your story has changed. That's it. Not because the market is panicking, not because you're bored, not because someone on TV made you nervous. You sell when the company's story, the reason you bought it, no longer holds up. If story A is getting better and story B is getting worse, sell B and buy more A. You're not abandoning ship, you're changing tables in the same casino. Investing isn't about loyalty, it's about opportunity. When I managed the Magellan Fund, I thought of my portfolio as 8 simultaneous poker games. I wasn't trying to win every hand. I was trying to stay longest at the tables where I had the best odds. That's how you should think about your own stocks. If you're holding 8 companies, you're playing 8 games at once. Every few months, check which stories are improving and which are fading. Keep your best tables, fold the rest. But here's the key. Stories rarely change overnight. Businesses evolve slowly. A great stock might take years to blossom. The worst mistake you can make is selling a good story just because it hasn't paid off yet. Patience, not prediction, is what makes you money. Look at the history books. In 1987, the market dropped a third in a few weeks. The headlines were apocalyptic. But the stories of great businesses, McDonald's, Coca-Cola, Johnson & Johnson, didn't change. Their earnings were fine, their managements were solid, their products still sold every day. 5 years later, those stocks had more than recovered. The people who panicked, lost. The people who held their stories, won. That's why you can't let the market's mood dictate your actions. The market is like a bipolar friend, one day euphoric, the next day depressed. If you listen too closely, you'll end up sharing its mood swings. Instead, anchor yourself to the company's fundamentals. When earnings are growing, debt is under control, and customers are loyal, don't sell just because prices wiggle. Prices are noise. Earnings are music. In 1990, when Saddam Hussein invaded Kuwait, the market fell more than 20%. Banks were shaky, recession fears were everywhere. But plenty of strong companies had nothing to do with oil or banking, and their stocks still fell. That's when I went shopping. Fannie Mae, for instance, dropped from $42 to $26, even though its profits were rising and its management hadn't missed a beat. The business was sound, the price was nonsense. It was like buying a $20 bill for 12 bucks. If you trusted the story, you made a fortune. So ask yourself, has the story changed or just the price? If the story hasn't changed, hold it. Maybe even buy more. If the story has changed, management stumbles, profits shrink, competition steals, market share, sell it, and move on. Don't complicate it. Here's how I make it simple. Every stock I own has a one-page note, why I bought it, what will make me sell it. When I feel tempted to panic, I read that page. If none of my sell reasons have happened, I stay put. That piece of paper is my seatbelt during market turbulence. Too many investors let emotion drive their timing. They sell winners too soon because they can't stand to see gains evaporate. Then they hold losers too long because they can't admit they were wrong. That's backwards. Winners deserve patience. Losers deserve honesty. If a company's story is strong and getting stronger, give it room to grow. If the story is crumbling, stop waiting for a miracle. Miracles are not an investment strategy. And remember, selling is not failure. It's recycling. It's moving capital from a dying story to a thriving one. Sometimes the best way to improve your portfolio isn't by finding new stocks, it's by getting rid of the ones that no longer deserve your attention. Don't confuse noise with news. Wars, elections, interest rate hikes, they all make headlines, but most of them don't change your stories. When the market panics, great businesses go on sale. That's not a reason to sell, that's a reason to buy more. The market fell 50 times by 10% or more in the past century. 15 of those times, it fell over 25%. Each drop felt like the end of the world. None of them were. If you'd sold in any of those moments just because you were scared, you'd have missed every recovery that followed. Volatility is temporary. Quality is permanent. Let's make this practical. Suppose you own two companies. One is a fast grower, still opening stores and growing profits 20% a year. The other is a mature, slow grower whose market is already saturated. Both go up 50%. Which one do you sell? You sell the slow grower. The 50% gain might be all it has left, but the fast grower could still double again. Don't use the same rule for every stock. Each story is unique. Some deserve more time, some don't. You don't prune a rose the same way you prune a cactus. And one more thing, never sell just because a stock feels expensive. Expensive compared to what? A great business always looks pricey to the impatient. A lousy business always looks cheap to the desperate. Focus on the story, not the sticker price. If earnings are climbing, the balance sheet is strong, and management keeps delivering, the stock will take care of itself. Here's your mantra. Sell the story, not the stock. When the story changes, get out. When it doesn't, stay calm. If you treat your portfolio like a garden trimming weeds, watering flowers, you'll do just fine. The hardest part of investing isn't buying, it's waiting. The second hardest part is not selling when you should hold. The third is not holding when you should sell. Master those three, and you're ahead of 90% of investors. So don't let price dictate your decisions. Let the story lead you. Buy strong stories. Hold patient ones. Sell broken ones. That's it. No formula. No emotion, just logic and a little courage to follow it. Most investors lose money not because they pick the wrong stocks, but because they treat every stock the same. They use one rule for everything. Sell when it doubles, or buy when the P divided by E is low, as if all businesses were made from the same mold. They're not. Different types of companies behave differently. They grow, stall, recover, or collapse in their own ways. So if you expect the same thing from all of them, you're setting yourself up for confusion and disappointment. To stay sane, I break stocks into 5 basic categories: fast growers, slow growers, cyclicals, turnarounds, and asset plays. Knowing which one you're holding is half the battle. Let's start with the crowd-favored fast growers. These are the rockets. They're companies growing earnings 25% a year or more. If they can keep that up for several years, the stock price doesn't just double, it multiplies tenfold. That's how you find a 10-bagger. A company that grows earnings 25% annually, doubles its profits in 3 years, quadruples them in 6, and grows 8-fold in 9. That's simple math. Fast growers can exist in fast-growing industries like technology or retail, or they can be a fast company in a slow industry. What matters is that they're expanding rapidly and reinvesting profits to fuel even more growth. The trick is to find them when they're still early in the story, what I call the second or third inning. Think about McDonald's in the early days. They had only a few hundred restaurants and a cheap hamburger that worked everywhere. Or Walmart, 10 years after going public, still expanding across America, still opening stores. You didn't need to be there from day one. You could have bought years later and still made 30 times your money. Or Microsoft, a few years after its IPO. Earnings were growing several times faster than the average company. The personal computer revolution was exploding, and they were at the center of it. Investors had plenty of time to ride that wave. But fast growers aren't forever. Eventually, they run out of places to go. The key question is always, how far is the runway? Once growth slows, they turn into our next category. Slow growers. These are mature companies, utilities, big consumer brands, funeral homes, food chains. Their earnings rise maybe 3 to 15% a year. No one gets excited about them, but they often pay steady dividends. A slow grower can be a great investment if the price is right. Imagine someone offers you a small business for $100,000 and it earns $50,000 a year. That's a 50% return. Even if it never grows, you'll make your money back in 2 years. That's not glamorous, but it's profitable. It's the same logic for stocks. If a slow grower sells cheaply and pays good dividends, you can earn solid returns without fireworks. But be careful, a slow grower that turns into a no-grower is bad news. Once earnings flatten or decline, dividends often get cut, and the stock price collapses. Look for steady growth in profits and a rising dividend. A company that raises its dividend every year usually signals confidence about the future. Service Corporation International, the funeral home company, did exactly that for years, a slow grower that quietly compounded 15% annually. Next, cyclicals. Cyclicals rise and fall with the economy. Airlines, car makers, steel companies, home builders, these depend on consumer confidence and big purchases. When times are good, their profits soar. When times are bad, their earnings evaporate. The mistake most investors make is buying them at the wrong time when everything looks wonderful. The best time to buy a cyclical is when the story shifts from awful to okay, when things go from bad to better, not from great to perfect. In 1990, Chrysler traded around $10 a share. The economy was weak, and people thought the company might fail. But the balance sheet was healthy, and the product lineup, minivans, Jeeps, and a new full-size truck was strong. When the economy recovered, profits exploded, and the stock went up several-fold. That's how cyclicals work. Misery first, money later. If you buy them when profits are already high, you're too late. To survive the cycle, pick companies with low debt and strong cash flow. That's how they endure the bad years and thrive in the good ones. Then come turnarounds. These are companies everyone hates, beaten down, ignored, written off. They've made mistakes, lost money, maybe even faced bankruptcy. But they have one thing going for them, a plan to fix it. A new product, new management, a cost-cutting program, a sale of a bad division, something concrete that can turn losses into profits. The key is to wait for proof. Don't buy just because it might recover. Buy when you see real evidence it is recovering. Turnarounds are rare, but when they work, they can be spectacular. SS Kresge, the company that became Kmart, was a dull retailer going nowhere. Then it reinvented itself, launched a discount chain, and the stock went up more than 50-fold. 2 and 2 sometimes equals 8 if the story truly changes. Finally, asset plays. These are the hidden gems companies sitting on valuable assets the market has overlooked. Maybe it's real estate carried on the books at ancient prices. Maybe it's patents, mineral rights, or a world-famous brand name. Walt Disney in the 1980s was a perfect example. After building Disney World and Epcot, growth slowed, and investors thought the story was over. But inside the company were treasures no one had valued properly: the Disney name, the characters, the film library, and hundreds of acres of prime Florida land. When Disney began monetizing those assets, selling merchandise, launching the Disney Channel, developing new parks, the stock took off. An asset play isn't about earnings growth. It's about discovering what's already there that the market hasn't priced in. These 5 categories aren't walls, they're guideposts. A fast grower eventually becomes a slow grower. A cyclical can become a turnaround. Businesses evolve, and so should your expectations. Small companies often have more upside than large ones because it's easier to go from 100 million in sales to 200 million than from 10 billion to 20 billion. But that doesn't mean big companies are useless. Some giants keep reinventing themselves and growing for decades. The point is simple. Know what kind of story you're buying. If it's a fast grower, be patient and let it run. If it's a slow grower, focus on dividends and value. If it's cyclical, buy when the news is terrible. If it's a turnaround, demand proof before you commit. If it's an asset play, understand what's hidden and why it matters. Investing is like medicine. The treatment depends on the diagnosis. So before you decide when to buy, when to sell, or how long to hold, figure out what kind of patient you're dealing with. Because in the end, every stock tells a story, but you have to know which kind of story you're reading. Let's be honest, valuation is where most investors lose their minds. They turn it into rocket science, complete with charts, formulas, and mystical ratios. But you don't need a PhD to figure out if a stock is expensive. You just need fifth grade math and common sense. When I talk about valuation, I'm really asking one question. How much am I paying for each dollar the company earns? That's what the P divided by E ratio, price to earnings, actually means. If a company earns $10 a share and sells for 100, the P divided by E is 10. In simple English, you're paying 10 years worth of earnings for one share. A high P divided by E means you're paying more for each dollar of profit. A low P divided by E means you're paying less. That's it. No magic. But here's the key. A P divided by E only makes sense when you compare it to something. If a company is growing earnings at 20% a year and has a P divided by E of 20, that's fair. If it's growing 20% but has a P divided by E of 50, that's expensive. If it's growing 20% and the P divided by E is 10, that's a bargain, assuming the story holds up. So here's my back of the napkin rule. A fairly valued stock usually has a P divided by E close to its expected growth rate. Growth of 15% a year, P divided by E around 15. Growth of 10%, P divided by E around 10. If the P divided by E is double the growth rate, be careful. If it's half, start paying attention. Of course, context matters. A high-growth tech company should have a higher P divided by E than a slow-growing utility. You wouldn't expect the same multiple for Coca-Cola and a steel mill. Valuation is about expectations. The higher the P divided by E, the higher the expectations and the less room for disappointment. I've seen wonderful companies destroy investors simply because they were bought at absurd prices. Back in the 1970s, Electronic Data Systems, Ross Perot's company, traded at 500 times earnings. 500! If you had invested at that price when Columbus discovered America, and the company's profits stayed the same, you'd just be breaking even today. Even though EDS later performed well, the stock crashed from $40 to $3 because the expectations were ridiculous. The business was fine. The price was insane. The opposite happens too. When great companies trade below their value, that's when you quietly load up. In 1987, when the market collapsed, the Dreyfus Fund stock fell below its cash per share. Think about that. You could buy a profitable business for less than the cash it already had in the bank. That's like buying $1 for 70 cents. If you find a company with real earnings, low debt, and a share price that's lower than its cash after subtracting all liabilities, that's an investor's dream. It doesn't happen often, but when it does, don't overthink it. Valuation is your safety net. It won't tell you what to buy, but it tells you what not to overpay for. Even the best story in the world can turn into a nightmare if you pay too much for it. Let's talk dividends for a moment, the quiet cousin of valuation. Dividends are the cash companies pay you for owning their stock, usually quarterly. Over the last half century, roughly half of all the returns from the S&P 500 have come from dividends. Half. A company earns money, say $5 a share, and decides how much to pay out. Maybe it gives you $2 and keeps $3 to reinvest. The annual dividend divided by the share price gives you the dividend yield. If the stock pays $3 a year and sells for $30, that's a 10% yield. Not bad. But beware, if earnings are only $3.10, that company is paying out almost everything it makes. There's no room for error, no money left for growth. Eventually, the dividend will get cut and the stock will drop with it. High yields look tempting, but if the payout ratio is too high, it's a red flag. A safer signal is a company that raises its dividend year after year. That means management expects earnings to keep rising. Few companies want to cut a dividend once they've raised it. Investors hate that. If a company has raised dividends for 10, 20, 30 consecutive years, that's worth noticing. It says we're profitable, we're consistent, and we respect our shareholders. On the flip side, if a company suddenly offers an unusually high dividend, 5, 6, 7%, ask why. Often it's not generosity, it's desperation. Now, let's look at the balance sheet, the part of valuation most people ignore. It tells you what the company owns, what it owes, and what's left for shareholders. Assets on one side, liabilities on the other. The difference is equity, the company's net worth. Here's what to check. Asterisk, cash versus debt. Does the company have more cash than short-term debt? Good. If not, risk rises. Asterisk, debt to capitalization. Add up long-term debt and shareholder equity. If debt makes up half or more of that total, that's heavy. If it's under 20%, that's healthy. Asterisk, hidden debt. Some industries, like retail or restaurants, lease property instead of owning it. Those long-term lease commitments are debt in disguise, usually hiding in the footnotes. Don't skip them. A company with lots of cash and little debt can buy back stock, invest, or ride out recessions. That kind of balance sheet is like armor in a sword fight. If you subtract a company's debt from its cash and divide the result by its shares outstanding, you'll get cash per share. If a company has 20 million in net cash and 4 million shares, that's $5 cash per share. If the stock trades at 10, you're effectively paying only 5 for the business itself. That's a bargain if it's profitable. When you combine all of this earnings, dividends, balance sheet, you can get a rough idea of value without spreadsheets or fancy models. And one more thing, ignore anyone who says valuation doesn't matter. That's the kind of person who buys champagne at gasoline prices. The goal isn't to find cheap junk. It's to find quality at a reasonable price. If the P divided by E is far below the growth rate, check for danger. Maybe the company's in trouble. If the P divided by E is far above, check for delusion. Maybe investors are in love with the story. The sweet spot is somewhere in the middle where the business is strong, the story makes sense, and the price still leaves room for upside. That's how you avoid heartbreak and hangovers. Valuation isn't about being clever. It's about being careful. You don't need to predict next quarter's earnings. You just need to make sure you're not paying tomorrow's prices for yesterday's profits. A fair story at a fair price will beat a perfect story at an insane price every time. So keep it simple. Know what you're buying. Know what it's worth. And never forget, arithmetic is your best friend in a market full of emotions. Earnings are the oxygen of a business. Without them, nothing else matters. When you buy a stock, you're not buying a lottery ticket. You're buying a share in a profit-making machine. And like any machine, you need to understand how it makes money and how efficiently it does it. So let's strip it down to basics. Earnings come from one formula anyone can understand. Revenue, cost equals profits. That's it. You don't need calculus, just common sense. If you want to know whether a company's story will last, ask one question. How are they going to make earnings rise? There are only two ways: increase revenue or cut costs. That's all. Every strategy you'll ever hear is just a variation of one of those two. If you're evaluating a company, don't start with headlines. Start with the income statement. It tells you what's really going on. Revenue is the total money coming in from selling products or services. Then come expenses, the money going out to make those products or deliver those services. What's left at the bottom is profit. You'll often hear people talk about profit margin. It's the company's efficiency score, how much profit it keeps from every dollar of sales. To find it, divide pre-tax earnings by total revenue. The higher the number, the better the efficiency. Profit margins tell you if a company's costs are shrinking or swelling. If sales stay flat but margins rise, management is cutting fat and improving productivity. That's a healthy sign. Compare margins to competitors or to the industry average. A company that consistently earns more per dollar of sales is usually doing something right. But beware of extremes. If margins are already far higher than everyone else's, there's probably not much room left to squeeze. Don't assume a company can keep cutting costs forever. There's a limit before you start cutting into bone. Now, let's talk about revenue, the lifeblood of growth. Sales can rise for only a few reasons. The company can, 1, sell its existing products to more customers. 2, create new products for existing customers. 3, expand into new markets, other countries, other demographics. 4, raise prices without losing business. That's it. Every growth story you'll ever hear fits one or more of those boxes. Look at McDonald's. If it had stuck with just cheap hamburgers at lunch, earnings would have hit a ceiling decades ago. But they expanded their menu, added breakfast, improved efficiency, went international, and kept opening new stores. Over 30 years, McDonald's earnings rose more than 80-fold. The stock, it went up 100-fold. That's what happens when a company keeps finding new ways to grow sales and maintain healthy margins. You don't need a crystal ball. You just need to check whether a business has room to grow. Is it already everywhere, or does it still have untapped markets? Can it raise prices, launch new products, cut costs without hurting quality? Every line of the income statement tells you part of that story. Let's take another example. Suppose you own a donut shop that sells 1,000 donuts a day for $1 each. That's $1,000 of revenue. After paying rent, flour, sugar, and wages, you make $100 profit at 10% margin. If you find a cheaper flour supplier or improve your baking process, and profits rise to $150 a day on the same sales, your margin just went to 15%. That's a 50% jump in profit without selling one extra donut. That's the magic of efficiency. Now imagine opening a second shop with the same economics. Suddenly, total profits double. That's growth by expansion. That's exactly what happens in big companies, just with bigger numbers. You can also learn a lot from how profits rise. Are they driven by temporary cost cuts or by sustainable growth in sales? Cost cuts give you a one-time bump. Revenue growth gives you a long-term trend. When evaluating a company, ask, asterisk, are sales growing steadily year after year? Asterisk, are margins stable or improving? Asterisk, is profit growth coming from real business or from accounting tricks? Companies can boost earnings for a while by laying off workers, cutting research, or selling assets. That's fine short term, but long term, it weakens the business. You want rising profits supported by real, repeatable activities, new stores, stronger brands, expanding markets. That's why you always connect the financials back to the story. If you think a company's profits will grow because they're launching a new product, check the income statement later to see if it's actually happening. Are sales up? Are margins holding steady? A good story must show up in the numbers eventually. If it doesn't, it's just marketing. You can also use margins to compare similar companies. If two clothing retailers both sell $10 billion a year, but one earns $1 billion in profit while the other earns only $500 million, guess which one has the better business model? Margins tell you who's winning the efficiency game. And if margins are shrinking year after year, it's a warning. Maybe competition is rising, maybe costs are out of control, maybe customers are switching. Whatever the reason, don't ignore it. Profit margins are the pulse of the company. Steady and strong means healthy, weak and falling means trouble. Now, tie this back to valuation. A company with rising margins and growing earnings can support a higher P divided by E ratio because the business is improving. One with falling margins deserves a lower one. The market eventually figures this out, but you can get there first by reading the signs. So forget the noise about economic indicators and Fed policy. Focus on the only indicator that matters. Are earnings moving up, and why? If earnings rise consistently, the stock will eventually follow. If earnings collapse, no amount of optimism will save it. Behind every stock is a company, and behind every company is an income statement telling the real story. Learn to read it like a detective, not looking for perfection, but for clues. Rising sales, expanding margins, lower debt, clean profits. Those are your fingerprints of success. When you find them, don't overthink. Buy the business, not the noise. Because at the end of the day, the stock market only cares about one thing, earnings growth. That's what moves prices, builds fortunes, and turns ordinary investors into legends. Everything else, headlines, predictions, drama, is just background music. The stock market isn't a puzzle to solve. It's a weighing machine, and the weights are risk and reward. Your job is to find the ones that tip in your favor. You'll never eliminate risk. That's impossible. The trick is to take intelligent risk, the kind that gives you far more upside than downside. When I bought a stock, I didn't ask, will it go up next week? I asked, if I'm wrong, how much could I lose? And if I'm right, how much could I make? That's the only question that matters. If your potential gain is 2 or 3 times your potential loss, you can be wrong 4 out of 10 times and still come out ahead. I've been wrong plenty of times. Everyone is. The difference is, I didn't need to be right all the time, just often enough and big enough to make the math work. I used to say, if I'm right 6 times out of 10, that's a good batting average. You don't need to hit every pitch. You just need to hit the fat ones hard. Think of investing like baseball. You don't have to swing at every pitch. You wait for one in your sweet spot, a company you understand, at a price that makes sense. Then you swing big. That's risk management, not with formulas, but with patience. Now, let's talk about timing. Everyone wants to buy at the bottom and sell at the top. Sounds nice. But it's a fantasy. No one does it consistently, not even the pros. The right time to buy a stock is when the potential upside is high and the downside is limited. When the story is solid, the price is reasonable, and your stomach can handle the ride. That moment doesn't come often, maybe once or twice a year for a stock you're following. But when it does, you have to be ready. The more confident you are in the story, the less risky the investment. When I understand how a company makes money, why it will make more, and how long it can keep doing it, that's a low-risk bet. Risk, to me, isn't volatility, it's uncertainty. I don't care if a stock jumps around, I care if the story's fuzzy. A small company with a simple, bulletproof story like early Walmart was far less risky than a giant with a complicated, declining business. In the late 1970s, Walmart looked like a small-town retailer. IBM looked like the future. But Walmart's story was simple. Open more stores, sell cheap goods, keep costs down. IBM's story was harder, the world's changing, and it's not clear who wins. Guess which one turned out safer? That's why you can't judge risk by size. You judge it by clarity. If a company's future earnings path is visible, it's low risk. If it's a fog of promises and buzzwords, it's high risk no matter how fancy it sounds. Once you've found a great story at a fair price, stop waiting for perfection. Investors waste years waiting for the perfect entry point. They want the stock 5% cheaper or the market a little calmer. Meanwhile, the business keeps growing and they miss the entire move. If you believe in the story and the valuation makes sense, buy some. If it drops further and the story's still intact, buy more. That's how you use volatility to your advantage, not by fearing it, but by treating it as a sale. When the market panics and sells off good companies, that's your clearance rack. Back in 1990, when the market fell 20% because of the Gulf War, I wasn't selling, I was shopping. Fannie Mae, for instance, dropped from $42 to $26, even though profits were still rising. That's a 38% discount on the same story. Those are the moments you live for. When fear rises, prices fall. That's when long-term investors quietly make their best buys. But remember, you don't have to do anything most of the time. The great advantage of the small investor is patience. You're not graded quarterly. You don't have a boss breathing down your neck. You can wait. When in doubt, do nothing. That's one of the hardest lessons in investing, that inactivity can be a strategy. Some of my best decisions were the ones I didn't make. I've had stocks I owned for a decade that required maybe a few hours of work per year, just reading the annual report, checking the story, confirming the fundamentals. The rest of the time, I did nothing. Dunkin' Donuts, for example, I owned it for 12 years. I called them once a year, maybe. The business didn't change much. People like coffee and donuts. The stock compounded quietly while everyone else chased the next big thing. Doing nothing is underrated. Most investors are their own worst enemy. They can't sit still. They see a little red on the screen and feel the need to act. But acting for the sake of action is how you turn small losses into big ones. Here's what you should do instead. Asterisk. Revisit your stories, not your stock prices. Asterisk. Confirm that the reasons you bought still exist. Asterisk. Add when fear gives you bargains. Asterisk. Trim when euphoria gets silly. Asterisk. And spend the rest of your time living your life. Because here's the truth. You don't get rich by watching the ticker. You get rich by owning good businesses for long periods and letting time do the work. Compounding doesn't need excitement. It needs peace and patience. And if you really can't stomach individual stocks, there's nothing wrong with mutual funds or index funds. They give you diversification automatically. You still get the long-term benefits of equities without the homework. Just make sure you understand what you own and why you own it. The point isn't to prove how smart you are. It's to build wealth over time quietly, rationally, without losing sleep. So here's your final checklist before you buy any stock. 1. Do I understand how this company makes money? 2. Do I know what could make earnings grow in the next few years? 3. Is the balance sheet healthy, low debt, strong cash? 4. Am I paying a reasonable price for that growth? 5. If the price drops 20%, will I still sleep at night? 6. What specific event would make me sell? If you can answer those 6 questions clearly, congratulations, you're already ahead of 90% of investors. Because most people don't lose money from bad luck. They lose it from bad preparation. So buy with logic, hold with patience, and sell only when the story breaks. If you do that, you won't need to predict the market or outguess the economy or chase fads. You'll just quietly build wealth while everyone else is busy reacting. That's how you win this game, not by timing it, but by understanding it. The market rewards clarity, patience, and courage, not brilliance. Keep your head clear, your stomach strong, and your focus on the only thing that matters. Good stories, fair prices, and time. Do that, and one day you'll look back and realize you didn't just beat the market, you outlasted it.